Bank of England says they are now going back to QE already. That's coming up on 3 Minutes on Markets and Money. One of the things that we've talked about before is that while the Federal Reserve is very staunch right now in their inflation fight, that they're going to continue to hike rates until inflation comes down regardless of anything else. We've said often here that market instability is going to be the key driver to that policy change. Well, it's already showing up, and with the Bank of England this morning going back to QE, ending QT, starting to buy bonds because of what? Market instability. And again, it doesn't take long. The big difference is that while having inflation is a problem near term, the best cure for high prices is always high prices. The problem for the Federal Reserve is that while they're fighting inflation by hiking rates and causing the markets to go down and other problems within the markets economically speaking, that's all fine until you get market instability. A credit crisis is much more damaging to the economy long term than inflation. And furthermore, a credit crisis in the market will bring down inflation extremely quickly. So again, the big risk for the Fed ultimately is market instability. Now, so far, markets are down about 23% this year, but this really has been a very orderly decline this year. We're down, retesting the June lows. Markets are very oversold here. Again, doesn't seem to be a lot of risk here in the domestic markets right now. But credit spreads are beginning to rise, and this is particularly because yields on the 10-year Treasury are continuing to pop up here, well deviated above the 50-day moving average. That's adding to the stress in the markets. Again, that deeper inversion of yield curves, that's starting to weigh on economic growth as well. But again, this very extreme rise in the 10-year Treasury yield is beginning to put pressure across the entire market, including housing and other areas. Again, this is that first kind of whiff of market instability. The other issue is now coming from the volatility index, which is actually also starting to show some signs of life. The volatility index is also rising well above its 50-day moving average as well, up above 30 here for the first time really, and at the highest level we've seen since going back to January of this year. So there is this beginning of the hint of some instability in markets, again, that we haven't seen this year so far. But if we're looking at the Bank of England as a proxy for what other central banks are going to do, it suggests that the Fed may be closer to pivoting on their policy, particularly if we begin to see more instability in financial markets over the coming months. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.